It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian shares slip, with traders trimming some holdings ahead of key earnings, economic data and central bank meetings. The dollar creeping higher ahead of the Fed's rate call. The yen holding around 12-week highs before tomorrow's BOJ decision. Governor Ueda's team set to make some big calls on rates and bond buying. Plus, we are counting down to Standard Chartered's second quarter earnings, with analysts focus on progress and cost-cutting efforts. Right, let's get a quick look at markets to start things off. Avril Hong's in Singapore. Avril.
Yeah, Paul, we're seeing a bit of risk-off in the markets today, aren't we, as investors look ahead to those key events that could really shape markets this week. Central bank decisions, key economic data, whether you're talking about China PMIs, non-farm payrolls at the end of the week, or even Australia inflation tomorrow. And then, of course, all those tech earnings dropping this week as well. Ahead of all that, we're seeing the Hang Seng leading declines in the region, down 1.3%, slightly firmer on the Bloomberg dollar index, some declines also on the Aussie dollar, along with crude prices. The yen hovering at those 12-week highs versus the greenback, with an eye on the BOJ. Paul.
All right, Avril, stick around. We're going to get more on markets with Wayne Gordon, MD of Commodities and FX at UBS Global Wealth Management. Wayne, I do want to start off with that Bank of Japan meeting. It is underway. We'll have an answer tomorrow. What do you think we're going to hear? Is it going to be tightening or tightening to come very soon?
I think, Paul, they're going to kick the can down the road. That's what I think. Of course, before we saw this dramatic rally in the yen over the last week, I think that there probably was more pressure on them to do a little bit more on the rate side. But clearly, the way the yen has behaved and that unwind of big short positions in the yen over the last 7 days or so, that's taken the pressure right off. Obviously, the macro side, it still looks pretty mixed from a data perspective. So I think we're more looking at an October lift. But from a bond buying perspective, clearly they'll continue to try and trim down the amount of bonds they're buying in the market. Yeah.
How much of an October lift are you expecting, and what are we looking at in terms of the terminal rate for the BOJ? Yeah,
I think, look, from a lift perspective, I think it continues to be very, very modest. I think from a terminal rate perspective, I think they'll continue to have to make small adjustments as they go through the year. But from a yen perspective, I definitely think here is an opportunity to start to, for those people who've been sort of stuck in the yen, I guess, it is an opportunity to start to trim back some of that long exposure that people sort of built over the last 12 months and start to rebalance their portfolios there.
I guess partly to your point, this unwinding we're seeing in yen shorts is also that preoccupation with what we're going to get from the Federal Reserve. Do you think markets are getting carried away with expectations for Fed rate cuts?
I think, look, that's a really important question, because clearly, we have 2 rate cuts for the rest of the year from the Fed. We think they kick off in September. Markets are actually pricing a little bit more richly than that. So we think that markets are getting a little bit overexcited. Clearly, the data in the US has been a little bit more on the weaker side in some of the areas. Particularly, we've seen with PMIs and so forth of new orders, they have been a bit on the weaker side. So I think from a Fed perspective, 2 rate cuts this year is where we continue to sit. Clearly, the dollar has weakened a little bit, but nonetheless, we've got this whole election risk to play out over the next, few months, and the potential for, additional tax cuts under a Trump administration, etc. And so from a dollar perspective, we're pretty balanced on the dollar. We see it fairly range bound over the next few months. And of course, market pricing maybe has to adjust back a little bit just because, it's now pricing around the 65 or so basis points by the end of the year cuts. Yeah.
Wayne, I just want to put to you our question of the day, in fact, and it's from a yen perspective. Do you see it gaining or weakening after we get these, decisions from the Bank of Japan and the Fed, which are looking to either go, one's going to look like tightening and the other's going to look like easing?
Yeah, so I think it comes down to the way in which guidance is projected. Now, the Bank of Japan has disappointed us on a pretty regular occasion over recent years. I don't think they're very cautious by nature. And so given where market expectations are for tomorrow, I think there's a greater risk that the Bank of Japan disappoint versus the Fed disappointing on a more dovish stance. I think Bill Dudley's article on Bloomberg actually just a few days ago signalling that the Fed really need to start to cut and cut quickly, I think really moved expectations to a very dovish I suppose, pricing for the Fed, as well as the rhetoric expected. So I think the Fed live up to expectations. I think the Bank of Japan disappoint expectations. As a consequence, in the short term, I think the yen can actually weaken a bit against the dollar again as a result.
What about the Aussie dollar? I think you see quite a fair bit of upside there, but I mean, hot inflation, one thing, bullish remarks from the governor recently is one thing, but do you see a tightening this late in the cycle?
I think, well, our call is that we do have an interest rate hike by the RBA at their next meeting. The reasons behind that are bedded down in our expectation for inflation at the second quarter inflation print this week. We actually think that core inflation in Australia, or trimmed mean, will come out around 1.1%. That is above the RBA's expectations of inflation. The RBA governor has expressed her patience with bringing inflation down to target is getting very thin. And so as a consequence, I think the RBA could actually engage in an insurance hike to make sure that inflation does return to target more quickly. Now, there's very little priced for the RBA. About 6 basis points is priced. So even if the RBA don't hike per se, they will have a very hawkish tone in their message. And given the reaction of the unwind of yen shorts last week versus Aussie longs, that we've seen over the last 7 days, we think there's a real upside potential for the Aussie, at least past CPI into the RBA meeting. As I say, particularly if CPI comes out around that 1 to 1.1% Q&Q. And so we actually have an upside for the Aussie of around the sort of 68 by the time we get into the end of the year. And then we actually see the Aussie gaining a little bit more into 2025, largely because we think the RBA will be one of the last G10 central banks to begin cutting rates. Relative to even New Zealand, where we think that New Zealand kick off their rate cutting actually this time around in August.
But at a time when major central banks are in easing mode or approaching easing mode, say for the BOJ, do you think the RBA is going to want to strike out on its own? Does that limit upside for the Aussie dollar, especially given the slide we're seeing in commodity prices?
I think we can tackle commodities in a minute, but just on the central bank itself, a lot of these inflation risks are very domestically focused now. It's not so much an international pressure coming into Australia. It's actually domestically prices around wages still rising, albeit more modestly, still quite quickly. And a lot of structural pressures on prices around housing, rental, etc., which is prices still rising at relatively high levels. So albeit they are moderating, but still at very elevated levels. And so I think that it's more of a domestic insurance hike relative to looking at the global environment. But having said that, even if they don't hike, they will be hawkish, and that means that the rates curve in Australia is going to be relatively flat compared to almost every other G10 central bank, with the exception of Japan, obviously, who are in hiking mode, relative to the rest of the G10, which have very strong downward sloping rates curves. But on the commodities side, yes, commodities have been quite battered over the recent 6 to 8 weeks. But look, on a relative basis, oil, we think that OPEC, which is coming up, will hold the course. We think that they will continue to remain and sit on their hands. We think that this will tighten the market further as we go into the fourth quarter. We're already seeing inventories in the US starting to come down quite quickly, and we think that will support oil prices higher in the short term. And then on things like copper, where that's also been beaten down significantly, Grid spending in China beat expectations today. Grid spending at CapEx expectations around 30%. The market was expecting a more around power demand growth of around 8 to 9%. So those drivers will clearly lift copper as well into the back end of the year.
Yep. Yeah, Wayne, I want to dig into your views on commodities a bit more when we come back after the break, but I do want to get your views, sticking with FX, on the Yuan, because it's continuing to weaken. Where's the floor here?
Look, from a Yuan perspective, we think that the PBOC will continue to effectively, they will continue to weaken the Yuan gradually, but we don't think there's any big step devaluations here, particularly ahead of the US election. They'll want to see the outcome of the US election before there's any material changes from a policy perspective when it comes to the CNY. But from an election hedge perspective, we think selling the yuan against the dollar is a good way to hedge some of the potential tariff risks, etc., which, irrespective of administration, tariffs are continuing to be a risk. Both Biden increased tariffs against China. Kamala Harris, as the nominee, or almost the nominee, is clearly wanting continuity from a policy perspective when it comes to democratic policy. And of course, we know what Donald Trump thinks. So the points are that tariffs are still a risk. We think that being short the CNY along the dollar is a good hedge against those risks.
All right. Thank you to Avril. Wayne Gordon, though, of UBS Global Wealth Management, is sticking around. As promised, we will get his calls on commodities in a moment. And also still to come on Bloomberg Markets Asia, Axis Bank is going to share their outlook on the Indian Rupee. We'll discuss where the currency's headed after a fresh low against the dollar. That's coming up. This is Bloomberg. All right, take a look at this chart. This is global commodities prices having their worst month in more than a year. That's 2 months in a row that we've seen global commodity prices declining. So for his view on that, let's get back to our guest, Wayne Gordon, MD of Commodities and FX at UBS Global Wealth Management. Still with us. Wayne, what's driving this? Is this a demand story, and do you have any concerns about global growth?
Look, I think, to be honest, Paul, I think that across the board, commodities are impacted by what has been very lacklustre manufacturing data in some areas, the roll down of some PMIs, even in Europe, where things were starting to improve, and of course, people starting to build in the potential for things like, trade wars and so forth, and the risks around the US election. Is there potential for upside here? Yes, there is on a 12-month basis. We still have a lot of supply side issues, geopolitics, as well as mine-related supply issues in areas like copper, areas like aluminium. And on the weather front, we have a potential La Nina event approaching us by the end of the year, and we know that that tends to mean lower South American production of grains and oilseeds relative to higher production, as we see in El Nino years. And agriculture has been particularly damaged by what's been very good supplies and very difficult demand conditions. So, short positioning in commodities is quite elevated, particularly in some areas. But gold has been the standout, and we still think that gold has further to run, with a target of around 2,600 by the end of the year and 2,700 by the middle of next year.
I want to come back to that gold call in a minute, but just in terms of, you've described the short position on commodities, some of those factors are seasonal, transitory, but if you take a look at longer term, I mean, these stories around the energy transition, electric vehicles aren't going away. Look at BHP today, it's lost more than 1%. With that in mind, this is a good opportunity to maybe add some positions to these big mining names.
Yeah, we think it is. And in fact, when I look at our Aussie portfolio, there is a number of opportunities to start adding back in some of these really large diversified miners, which, let's not forget, are running very low debt levels and making very sizable distributions to shareholders. In the end, we have a very positive view on copper. We have a relatively flat view on iron ore from here. And we think that, commodities like aluminium, which, as you say, are crucial to the transition to low carbon energy, are trading close to or around cost. So from that perspective, we think that the bottom has been made in a number of these commodities, which have also dragged down these key mining stocks. And so as a consequence, this is a real opportunity on a multi-year basis to be getting into some of these segments at very low levels. Not just also that, but from a mining perspective, when you think about, miners who both mine gold and things like copper, the opportunity to be getting leverage to the upcycle still in gold as the Fed start to cut rates, at the same time as being involved in this shift to low carbon intensity of energy, and all of the bits and pieces that are required to secure grids, etc., as we spoke about earlier. These things are going to be fundamental demand drivers over the next 3 to 5 years.
I want to get back to that call on gold, though, because I think you said $2,700. That's a pretty aggressive price target, and also suggests that, well, maybe long-term the picture's not so good. What are the factors driving that call?
Well, interestingly, part of the factor is around the easing of interest rates. And what we've found historically is what's been absent from the gold market over the last couple of years has been demand from exchange-traded funds. Now, the demand from exchange-traded funds, or outflows of exchange-traded funds, as we've seen historically, has tended to drive the trend in gold prices. The dislocation occurred when we saw the step-in of central banks who wanted to diversify their holdings away from the US dollar. Now, we don't think that trend to diversification has ended by a long shot. And the World Gold Council data, which is released today, which is the definitive measure of what's been happening in the official sector, while we think that the trends there have moderated to some degree over the second quarter, we're yet to see the data, of course, but we think that the trends have moderated over the second quarter. We still think that they're very elevated relative to history. And in fact, we think that central banks this year could be buying anything between 900 and 950 tonnes of gold. Now, if you remember last year, of course, they did buy above 1,000 tonnes of gold, and the year before that. But prior to that, central banks were only buying around 350 to 400 tonnes from 210 to around 220, 221. So there is still that fundamental support for gold at these elevated levels. And then, of course, as we expect the Fed to start cutting rates and potentially cut rates even more quickly than markets expect if the data does continue to be weak, then we think that central banks and ETFs will be buying gold. That can push gold to 2,600 and then 2,700 by the middle of next year.
All right, Wayne Gordon of UBS Global Wealth Management. We're out of time, but thanks for joining us. We do have plenty more to come. This is Bloomberg. The US and the Philippines Foreign Affairs and Defence chiefs are currently meeting in Manila for the so-called 2+2 dialogue. Antony Blinken and Lloyd Austin are sitting down with their Philippine counterparts Enrique Manalo and Gilberto Teodoro. Blinken and Austin have met with President Ferdinand Marcos Jr., reaffirming Washington's support for the Philippines to defend its sovereign rights amid tensions with China. And our China correspondent Min Min Lo joins us now. So Min Min, the US expected to announce $500 million in funding to boost Philippine defences. How could this change the security calculus in the region?
Yes, Paul. Well, Anthony Blinken is on this turbocharged itinerary around the region, visiting 6 countries, trying to sign more agreement, it seems, perhaps to create a more lasting legacy that could be more difficult for any new president to undo. And now there are reports that Washington is trying to, may likely announce new funding for bolstering Philippines military and also to make more progress on this military pact that could allow U.S. to deploy high-level intelligence and also more sophisticated weapons, including missile systems, in the Philippines. Now, the U.S. may see this as a step up in deterrence, but Beijing is likely to see it as an act of provocation of the U.S. trying to sow discord in the region, especially after Manila and Beijing have already come to a sort of temporary agreement to allow those resupply missions to the disputed Second Thomas Shoal in the Spratly Islands. And this comes also after Blinken had just left Tokyo, where he agreed to revamp the military there, to increase defense cooperation there. Really, Beijing is going to see this as an encirclement of the country with U.S. footprint in the region, not setting a very stable backdrop for the future of U.S.-China relations and peace and stability in this part of the world.
Well, we've also got Italian Prime Minister Giorgia Meloni in Beijing for a 5-day visit. What's come out of those talks so far with President Xi?
Yes, she met with President Xi and she has offered to broker better trade relations with the EU, but that's after Italy had supported those EU tariffs on Chinese EVs. And at this point, it's not clear how much clout Meloni actually has in influencing the European Commission's trade policy, given that she was sidelined in the EU's parliamentary election in June. She was kept out of closed-door meetings for the union's top jobs. But at this moment, though, this is an attempt for the two countries to manage any potential fallout from those tariffs, with President Xi saying he is hopeful that Italy will provide a non-discriminatory environment for Chinese firms, and Meloni also calling for a more balanced trade relations. That's because China and Italy still have $80 billion in annual trade that is still heavily tilted in Beijing's favor. And then there is also those geopolitics matters of concern as well. Meloni raising the issue of Ukraine and the Gaza conflict. She sees President Xi as this important interlocutor when it comes to managing geopolitical tensions in the region, especially with the uncertainties about Washington's commitment to the EU and to Ukraine as well if Trump were to come into power in November.
All right, Bloomberg's China correspondent Min Lo there. Let's get to another top political story that we're tracking. Venezuelan President Nicolas Maduro says many protesters who rallied after his contested election win have been detained. Maduro says the protesters are mostly criminals and warned they will be severely charged. Meanwhile, opposition leader Maria Corina Machado says her team can prove their candidate, Edmundo Gonzalez, actually won the election. She told supporters they have enough voting tabulations to show Gonzalez received more than twice as much support as Maduro. All right, let's take a look at what's moving on global markets at the moment. Of course, a lot of volatility in markets as we count down to those dual central bank decisions from both the BOJ and the Fed. We've got the China CSI 300 and South Korea's Kospi among the worst performing at the moment. We've got Hong Kong's Hang Seng Index also off by more than 1%. Plenty more to come. This is Bloomberg.
The Bank of Japan is going to deliver tomorrow, and that we're going to see the yen strengthen. The Bank of Japan has consistently kind of missed the mark of expectations. I think this time is different.
Really hard with the yen at the moment, because you just cannot underestimate the willingness of the Bank of Japan to do the opposite to what the market expects. I would expect 145 is more likely than 160, but lock in some volatility over the course of the next 5 to 10 days.
Fundamentally, we're of the view that getting a much stronger yen than that sort of level of 150, I think requires either a much more hawkish Bank of Japan or a much weaker growth outlook in the US. Neither of that we expect. So I think we are living in a world where the yen is going to remain weak. But I think people are, betting too fast on a big strengthening of the yen. I don't think that's going to happen.
Some of our guests speaking there on the outlook for the yen as the Bank of Japan begins its two-day meeting. And let's check in on markets in Japan. Avril's keeping an eye on things. Avril.
Yeah, Paul, we're back from the lunch break. Today we're seeing Japanese equities under pressure. Investors taking risks off the table ahead of that policy meet. The consensus seems to be a hawkish BOJ, dovish Fed. Regardless, the Fed is what we'll hear from just not so long after we hear from the BOJ. And this could be a double whammy of policy news that could jolt the yen in either direction. Today you're seeing the yen giving up some of its gains, hovering around the 154 level. We also got data ahead of all this. The jobless rate edged lower, coming in slightly lower than expectations as well. And this is still a pretty tight labor market that we're seeing, so the likelihood of upward pressure on wage growth still there. And I think something for investors to chew on ahead of the Japanese central bank's decision. Let's bring in Bloomberg M Life strategist Mark Cranfield for a chat. So Mark, we heard from some of the guests, 145, 160. Do you think the yen is going to soar or soon?
Well, what traders have got used to is that after Bank of Japan statements come out, then you have the press conference by the governor. And it's often during this press conference that Governor Ueda has actually dampened down expectations. And that's where the dollar buying starts to happen. So we've really got used to the idea that dollar yen gradually rises during these meetings. And that by the end of the day, dollar yen is higher than where it was before the meeting began. Coming into this one, because the yen has strengthened a reasonable amount before we even get here, the expectations are high, there's a lot priced in. It could be one of these classic situations of buy the rumor, sell the fact. People already think that Bank of Japan has to do something, this so-called double move with a rate hike and a reduction of JGB purchases. But will it be enough to satisfy the people that have been buying the yen recently? Maybe not.
What about some of the other crosses that we'll see more vulnerable to this if the BOJ disappoints?
Well, certainly the obvious places where people might jump in will be something like the euro. The euro ECB sounds as though they're only going to do one more rate cut this year, which is disappointing to some people. They thought it'd be a whole series of cuts, so the euro probably performs better. A currency which has fallen a lot recently is the Australian dollar. We have tomorrow, by coincidence, we have an Australian CPI report, which is seen as being very, very important for the RBA decision next month. Now, if that CPI comes out on the strong side, it may well tip the RBA into another rate hike, which is, after a long period of doing nothing, that would be a bit of a surprise to the market and probably boost the Australian dollar. So certainly Australian dollar, euro are two currencies that will be very much in focus if the yen is on the move tomorrow.
Okay, so sometime down the line this year, we might see that RBA hike. Certainly markets expect the BOJ one. What do you see as the terminal rate, though, from the Japanese central bank? Probably
something like Bloomberg Economics is saying that 0.5% is probably something similar to a neutral rate. It's not exactly the same, but most countries are looking for a so-called neutral area. Even that, though, is below inflation, so maybe a touch higher, but let's say 0.5, 0.75, somewhere in that kind of range, which obviously on a global basis is very low and still gives the yen so-called funding qualities. People may still think that it's a currency to short, but certainly we're only at 0.1 on the top of the band at the moment, so quite a way to go. Bloomberg Economics think in two steps, one step tomorrow and then another one later in the year, probably October. But they need to guide. They still need, the central banker, governor especially, still needs to give forward guidance that that's his target. Otherwise, the market will just look elsewhere.
You've been looking back in the history books and how the TOPIX was rising between 2006 and 2008 despite rising rates. What's different this time around and what sectors do you think can do well?
Well, certainly in favour is the fact of the yen. The yen was actually stronger back in 2006. On a trade-weighted basis, it was actually stronger than it is today, so exporters clearly get that in their favour. Governance has changed a lot more favourably for Japan. The Tokyo Stock Exchange especially has been forcing companies to be more open with their accounts and with what they're doing. Higher dividends as well, encouraging them to pay higher dividends. So the fundamentals for the Japanese stock market are actually much better than they were in 2006, and they've got the favourable yen as well. So they can probably withstand this. There's no particular reason why. They're already making good money globally, and just because the yen strengthens a little bit or Bank of Japan hikes, probably not going to really make a big impact on them.
Attractiveness in Japanese equities, I suppose that doesn't bode well for Chinese ones. We're seeing China-heavy ETFs selling down this week. Given all these key event risks, what do you think we should be watching out for going forward?
I think what you're seeing is kind of a top-down approach from global portfolio managers, and we were talking earlier about Temasek, what they're doing, and that is probably representative. If you're a major global fund manager who can put his money anywhere around the globe, you're probably assessing the outlook for China, particularly against some of the other major countries in the world, and saying, well, look, the prospects for the next 5 years look brighter in other places. And particularly when you consider that pre-pandemic, people were skewing a lot of money towards China. That's become a bit disappointing for them. They're probably scaling back, and they've got to look elsewhere. Where are the most promising parts of the world? Obviously, America stands out as one of those, but possibly also Europe, South America, other parts. But clearly, China is not helping itself, because the Chinese authorities keep on putting off investors by introducing things which turn them away. Just for an example, that turning off this data, this daily flow of data, is not a great idea. Foreign investors want transparency. They don't want to find out later what's going on. They want to know on a day-by-day basis, particularly real time, if they can get it. These things are reasons for people to move their money somewhere else, and you can see that happening. And what Temasek is doing will not be unique. Other major companies are probably doing the same kind of thing.
What about some of the sectors that you still think might do well domestically? I mean, Temasek also looking to expand some of the investments in EVs. Is that something that we should be looking at? Anywhere where the Chinese authorities and the government have shown that they want to support those. So yes, EVs clearly, anything green related seems to be a high priority for China, so those will probably do well. They need to boost the consumer sector a lot, and they will probably put effort into that as well. There are certain parts of the tech sector the government say are fundamental to improving things in China, so they will probably do okay as well. And then you've always got the state-related companies, the companies that are linked to local authorities as well. They always have continuous support with any kind of rebuilding process, possibly even to making property more affordable in certain aspects. So people will closely watch where the government is putting the priorities, and those companies are likely to outperform the others. Investors should follow suit. Mark, thank you so much. Great to chat with you as always. Bloomberg's MLive strategist Mark Cranfield speaking to us. Back to you for now, Paul.
All right, thanks overall, Mark. Let's get to today's big take now. Even with costs in Japan rising, many small businesses there are struggling to figure out how to raise prices after decades of deflation. The pressure has prompted some business owners to take classes on negotiating higher prices. Bloomberg senior editor Reed Stevenson has more. Reed, I understand you sat in on one of these classes. What material gets covered? What are the students getting told?
Indeed, it was really interesting because this was far away from Tokyo, where you have the big companies, and it was in the western part of Honshu, the main island of Japan. And you're sitting amongst small to medium-sized businesses that are really representative of the vast majority of economic activity in Japan. In fact, 90% of Japan's companies are small to mid-sized businesses. And here you discover that many of the people who sit across negotiating tables from these kinds of companies have never actually been in a situation where they've had to push their customers to pay more for their goods and services because of 3 decades of economic stagnation and deflation in Japan. And so this has sort of become a lost skill. And in these classes, you get the sense that they want to regain this skill. They want to learn how to go in and ask for more money, which is really also what the central bank wants to see in terms of getting the economy going, getting sort of a healthy wage price cycle going as well, Paul.
Yeah, it certainly sounds like a weird problem to have. I can't imagine it happening here in Australia. But why is it that Japanese companies, especially the small ones, are just finding it so hard to put up the price and effectively say, well, that's the price?
Well, you have to realize that many of the customers of these smaller companies are in fact larger companies, and so the Toyotas and the Sonys of Japan, they enjoy a certain amount of pricing power. They also export a lot, and so they get to sort of reap the benefits of a weaker yen, economic activity. But what really needs to happen is a lot of that needs to filter through into the smaller businesses of the economy, because that's where a lot of the employment is. And what you're finding there is, a lot of the employees, they're seeing their living costs go up. Things cost more at the grocery store, energy prices are going up. So they need to pay their employees more. And unless they're able to sit across from a negotiating table and say to their customers, the larger companies at which for a very long time they were at the mercy of, you need to pay us more for the goods and services we provide.
So what did you learn about the company that you talked to and the instructor?
The company that I happened to run into at that class was called Hinoden. They're a small maker of sort of control panels that you see in factories and at water pumping stations. And there, the 44-year-old manager who sort of was responsible for sitting at the negotiating table, he wanted to know how he could go in and sort of push for higher prices for his company and his employees. And so, for example, the instructor taught him, here's how you use publicly available data, here's how you sort of frame the discussion in order to push for what you need to see on the other side of the table. And the instructor himself was really interesting. He has been doing this for a long time, but has been extremely busy in the last couple of years as companies seek out these sort of skills. And even though the instructor himself is about to retire, I asked him a question which you're always sort of surprised and not surprised to hear the answer, which is he himself has not raised his own prices.
I was just wondering, Matt. Reed Stevenson, Bloomberg Senior Editor, thank you so much for joining us. And for more on this story, you can also listen to our Big Take Asia podcast. New episodes drop every Wednesday on iHeartRadio, Apple Podcasts and Spotify. Still to come, Axis Bank shares their outlook on the Indian rupee. Hear why they think the currency's fundamentals remain strong. That's next. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You are watching the India Focus. We've got markets in India opening in about 1 minute's time. Looks like we're going to have a fairly flat session. Markets around the Asia Pacific at the moment broadly weaker. The rupee unchanged, still hovering around those record lows. Well, let's get some more perspective on India with Niraj Gambhir, Head of Treasury Markets and Wholesale Banking Products at Axis Bank. And Niraj, I want to start off with that surprise announcement that we had from the Reserve Bank of India yesterday. Foreign investors aren't going to be able to buy freshly issued bonds anymore freely. What's going on here? Is this about controlling inflows or something else? The bank didn't give us a reason.
Yeah, it's a bit of a surprise announcement. We are ourselves not very clear as to why Reserve Bank has chosen to exclude these two securities from the eligible list of securities which foreigners can freely buy. It does look like that they want to basically limit the sort of universe that is available to the foreign investors for the time being. But please bear in mind that the overall universe of the securities which is available for foreign investors to buy is pretty large. So as far as the index related flows are concerned, I don't think it should have a material impact on it. But as a decision, it's a bit of a surprise decision.
Yeah, it wasn't that long ago with much fanfare. We were discussing here on this show and everywhere else as well that India was getting included in the JP Morgan Emerging Markets Bond Index. Are there any implications for that? We also haven't heard from JP Morgan. And do you think this is going to affect India's reputation as a destination for foreign investment?
I don't think it fundamentally changes anything. It's just that as far as the index inclusion is concerned, the full universe was not included. Only a select securities were included. So these securities will not form a part of that universe. So, but per se, I don't think it fundamentally changes anything.
We've noticed also, allied to that, and you note as well, that foreign direct inflows into equities have been a bit of a weak spot. And I think it was yesterday we saw another 24 billion rupees worth of Indian stocks sold off. When do you see that trend reversing?
I think it's a bit of a global phenomena. As far as India FDI flows are concerned, they were pretty strong. I think in 2021-22, we've seen weakness since 2023. As the elections are behind us, we now have a very stable government at the center. The policy making is seeing continuity, and there is a very strong thrust on manufacturing and job creation in manufacturing. So I think that it's only a matter of time that we will start seeing the FDI flows into the country, start picking up. Bear in mind, a large part of the FDI flows in the country were on account of the investments by, foreign private equity firms. They were pretty active in the Indian space for quite some time, and those flows have kind of, taken a bit of a beating, particularly in the fintech sector. So I think as those flows, reemerge, US rates kind of come down, we will see FDI flows into the country start inching up.
Yeah, and yesterday we saw Indian stocks closing near a record. Do you see domestic buyers taking up the slack in the meantime?
Well, it has been a domestic buyer story all along for quite some time. I mean, if you see the flows into domestic mutual funds, they have been pretty strong. They have been consistently been strong for quite some time now. And I think that those flows are likely to continue to be strong as Indian investors shift their savings from other instruments into equity-linked instruments. I think we have seen that trend over the last few years, and that trend is only gaining pace. I don't expect the flows from domestic investors to taper off anytime, and that would basically mean that even if the foreign investors, are not buying too much into Indian equities right now, the domestic story will continue.
There's been a pretty strong run-up in Indian equities, and the story that underpins that is quite compelling as well. But do you think we're at the risk of a correction or a pullback here?
Equities, I think, can see a little bit of sort of profit-taking or some sort of, correction at this point in time. I think the markets have priced in quite a bit of good news in the economy. We have seen it's been largely a liquidity story. We have seen quite a good amount of flows from the domestic investors, as I was saying before. As the market sort of waits for a new round of, information, we are in this result season. As people sort of parse through the results from the companies, we will see some bit of, pause or some bit of correction here. It's possible. But overall, I think it is still a very strong domestic flow story.
Well, we've got a very weak rupee as well right now, 83.73.37, and been losing quite a bit of ground. I'm just wondering where you think the direction for the rupee is, though, because we've got the Fed probably looking at easing as its next move, if not this month, September. But the RBI's next move probably going to be lower as well. So what's this mean for the Indian currency?
Rupee has been a bit weak of late, but it is, if you look at year-to-date performance of rupee, it is actually one of the stronger currencies in the wider emerging markets basket. Overall depreciation for the year has been less than 1%. And I think that's partly because of the fact that, as we were mentioning before, there were, portfolio inflows are strong, largely because of index flows into fixed income. But also the fact that current account deficit is actually at an all-time low. It's less than 1% of GDP this year. So overall balance of payments is pretty much strong. We are expecting India to have a balance of payment surplus of about $50 to $55 billion this year, which basically means that on a fundamental basis, rupee remains strong. It's just that dollar is also strong, and dollar is particularly strong against some of the Asian currencies, for example, Japanese yen. And some of that is having a rub-off effect on rupee. Reserve Bank has been very actively intervening in the markets. So I think they are also kind of trying to keep the volatility in the rupee at all-time lows. So on a fundamental basis, it's a strong story. On a fundamental basis, we don't see any big concern around rupee, but I think there is a slow creep in terms of depreciation. And I think we should see about 1 to 2% depreciation on rupee in this year.
All right, Niraj Gambhir of Axis Bank, thanks so much for joining us. We do have plenty more to come. This is Bloomberg. Investors are awaiting Standard Chartered earnings expected in the coming hour. Analysts at Jefferies and Morgan Stanley see the bank announcing $1 billion share buyback. So let's get more from Avril Hong in Singapore. So Avril, buyback, I understand costs and focus as well. What are we listening out for?
Yeah, just what you mentioned. We're expecting potentially a further share buyback of as much as $1 billion. As you say, the likes of Jefferies see this happening as StanChart seeks to return billions of dollars to shareholders. But cost control also in focus, and Bloomberg Intelligence actually sees the second quarter expense base coming in seasonally higher, and this is due to staff performance-related pay adjustments. So the estimate for expenses is coming in just under $3 billion. We're going to be keeping an eye on its pre-tax profit. The estimate is for just over $1.6 billion on this. But of course, the other thing that we're watching out for is whether StanChart says anything in relation to its exposure to Hong Kong, to China real estate. For now, in terms of analyst recommendations, 13 say buy, 8 say hold. We have 1 sell call there. This is a stock that has run up about 10% so far this year, despite coming off from its May peak. Paul.
All right, thanks very much, Avril. And we will be speaking exclusively with StanChart CEO Bill Winters after those results are released, and that's coming up at 1:30 p.m. Hong Kong time. Right, some more earnings results that we're following. McDonald's has shrugged off the burger chain's first sales drop in 4 years, pledging to launch new promotions. Second quarter comparable sales fell 1% year on year, with CEO Ian Borden warning of further weakness as cash-strapped consumers curb their spending. Investors, though, retained their appetites, shares posting their best daily gain since 2022. Heineken shares slumped in Amsterdam after the beer maker took a $949 million impairment on its stake in China's largest brewer. It says the value of its stake in China Resources Beer tumbled on concerns about consumer demand in Asia's biggest economy. Similar weakness in the US and Europe saw the brewer narrow its forecast for full-year profit growth. Let's check in on some of the stocks that are moving at the moment. BHP, the world's biggest miner, a bit weaker here in Sydney. It has set up a joint venture with Canada's London Mining Group to buy copper miner Filo Corporation. That'll give us access to projects in Chile and Argentina. So the price softening a bit there, but look at Fortescue, down more than 9%. This is after Capital Group companies sold 1.9 billion Aussie dollars worth of stake in the iron ore miner. Of course, Fortescue, a pure play iron ore company. Also taking a look at Samsung, that's a bit softer as well, even though it's suffered a series of setbacks in developing the type of memory chips crucial for AI. All right, that is it for Bloomberg Markets Asia. Horizons Middle East and Africa up next. This is Bloomberg.